Hello, I'm Jane. Today me and my groupmate Weihan are gonna make a presentation on our CBT test titled Application of Simulation. Today we'll explore how simulation is applied to address financial challenges in the insurance sector, focusing particularly on the implications of uncertain interest rates towards the pricing of the premium. Financial challenges. In an ever-evolving financial landscape, one constant remains: the unpredictability of interest rates. Uncertain interest rates means that the future path of interest rates is unknown or variability over time. This uncertainty can be due to various factors, including economic conditions, inflation, monetary policies of central banks, and global financial events. Interest rate has been in an increasing trend throughout the year 2023 in order to control the rising inflation rate. Now, we will discuss the impact of interest rates in the insurance sector. First, investment returns. Insurance companies usually invest premiums heavily in interest-bearing assets like bonds, where the returns are highly sensitive to interest rates. When interest rates are low, the returns on these investments are reduced, impacting the insurer's profitability. However, rising interest rates can negatively affect equity markets, which decrease the market value of existing bonds, potentially leading to unrealized losses in insurance companies. Liability valuation. Liability valuation in the insurance industry refers to the process of determining the present value of future obligations that an insurance company owes to policyholders. Interest rates also play a crucial role in liability valuation, where high interest rates can decrease the present value of future obligations, temporarily inflating profitability. But this can lead to an underestimation of future liabilities if rates decreases, causing a substantial financial strain and reducing available capital for other users. Next, product pricing is another area significantly affected as the interest rate environment impacts how insurers price their products. When interest rate is high, insurers may increase premiums, particularly for products with savings or investment components. This helps maintain profitability but may affect the attractiveness of these products to consumers. Now, we will look into some past events where interest rates have brought significant impact to the insurance sector. First, the 2008 global financial crisis, marked by a sharp decline in interest rates to 0 to 0.25%, many insurance companies invest heavily in financial instruments, including stocks and bonds. The crisis led to a sharp decline in the value of these investments, causing substantial losses for insurers with exposure to risky assets. Economic downturns are typically associated with an increase in insurance claims. During the financial crisis, there were higher occurrences of events such as business failures, bankruptcies, and unemployment, leading to an uptick in claims across various insurance lines. Next, US housing market crash in 2006. Interest rate was set to 1% during the recovery from the dot-com recession. This makes housing loans extremely affordable for the people, causing the economy to overheat. Fed tried to cool off the economy by increasing the interest rate 17 times. And many people couldn't handle the interest rate hike as they are subprime borrowers. This causes a huge loss in mortgage-backed securities, a type of financial instrument that represents an investment in a pool of mortgage loans. When the housing market burst, this caused the securities to free fall, causing huge losses. Then, this also causes a large exposure to credit default swap, a financial derivative that allows an investor to swap off or offset their credit risk with debt with another investor. The widespread mortgage defaults led to substantial payouts on CDS contracts, impacting the financial stability of some insurance companies. Next, the collapse of AIG, a giant in the insurance world, further highlights this risk. In Q4 of 2008, AIG reported 62 billion loss. Since it is too big to fail, AIG received a staggering 182 billion from the USA government. The main causes of the collapse is heavy exposure to risky securities such as mortgage-backed securities and credit default swap. Next, lack of adequate risk management, as there is no adequate reserve for potential losses. Now, we will focus on unit-linked endowment policies, where we simulate optimum premiums for these policies amidst changing interest rates. There are several characteristics for unit-linked endowment insurance. First, they combine life insurance coverage with investment opportunities. A portion of the premiums paid by the policyholder is used to provide life insurance coverage, while the remaining is invested in various types of investment funds. This setup offers both the benefit of life insurance protection and the potential for capital growth through investments. Next, flexibility in premium payments. Unit-linked endowment insurance offers flexibility in terms of premium payments. This flexibility makes it easier to maintain the policy during times of financial uncertainty or adjust investment levels according to changing financial goals. Then, variable returns based on market performance. The returns on the investment part of these policies are directly tied to market performance, as the funds are typically invested in a mix of assets like equities, bonds, and others. The policy's value can fluctuate based on how these assets perform. This means the policy's maturity value or the death benefit could vary, reflecting the underlying investment gains or losses. Now I will pass it to Wei Han.
Hello everyone, my name is Wei Han and I'll talk about the simulation and the Excel part. Okay, firstly, we have taken the initiative to model the future interest rate. So the first thing we do is we have collected data of federal interest rate from the year 2020 up until December 2023. So that's approximately 205 data. So of course, we have collected large enough sample to ensure that our study is actually accurate. Okay, so it's kind of impossible for us to just take 5 data and then try to make the forecast, right? I don't think that one will be very accurate. So yeah, I think 200 would be a good number, okay? Especially when it starts COVID, okay? We can see the interest rate hike, okay? So we can observe from the graph here, okay, that the interest rate is actually showing an uptrend, okay? So this uptrend gives us a huge problem, okay? So the typical interest rate model, which is the Westic and the Cox, Ingres, and Ross model, they can't account for any uptrend, okay? So we have decided to use exponential smoothing, which is a type of time series to account for seasonality and also uptrend, okay? So based on our forecasting here, okay, we have forecasted that on March 2024, the forecast interest rate will be around 5.70%, which is approximately 40 basis points higher from now. Okay, so yeah, we have to take some steps in order to keep our company in good financial health. Next, I'll explain about the concept of calculating the MPV of a unit-linked investment policy. Firstly, the premium is split into two parts. Okay, so after one is allocated premium, which is the part that will go into the unit fund, okay, the premium is multiplied with the allocation rate. Now, we have a rule of thumb here. Okay, the rule of thumb is to have a lower allocation rate in the first year as compared to the other years, as we need to allocate more for non-unit fund, okay, in order to set up the policy. So all of the allocated premiums will be used to purchase units in the investment funds selected by the policyholders during the initiation process. Okay, 5% bid offer spread, right, is actually the standard rate for unit-linked investment policies. Okay, so of course, fund management charges and also administrative expenses will be charged at the end of the year. The fund in the unit fund will be compounded with unit interest rate based on their investment choice. So in this part, we are assuming our unit interest rate, okay, as the federal interest rate. So in practice, the unit fund interest rate and the federal interest rate vary slightly. Okay, overall, it is the company that decides the interest rate. Okay, so let's proceed to the non-unit fund calculation. Okay, the balance of unallocated premiums after deducting all of the expenses, okay, will be calculated with the non-unit fund interest rate that is fixed by the company as well. The management fund, okay, will be added as a profit, okay, to the company. So the most important thing here we have is the expected debt cost. So expected debt cost is basically the expected cost that is needed to add on by the insurance company, okay, when the unit fund is not enough to cover the death benefit. Let me explain in a simpler way. So let's say here we have 30,000 death benefit, and on the first year, okay, we have approximately 470 in our unit fund. So obviously that's not enough to cover. That's far from enough. Okay, so what we have to do is we have to allocate more money. How do we determine that allocation? Okay, we will need to use the death benefit and then minus the fund after management fund in the unit fund. Okay, and then we will have to multiply by the probability of death of that individual in that year. Okay, that will give us this amount, expected death cost. So this $17, the insurance company will have to top up. Okay, we have to top up. So after that, okay, a positive, okay, we will calculate the profit signature for each year, which then we will calculate the net present value. Okay, a positive net present value indicates that this policy at this premium, okay, is profitable to the company. Okay, so that is the overall process of calculating the NPV of unit-linked investment policy. So let's talk about the simulation part more. Okay, so I have simulated 50 sets of whole calculation. Okay, whole calculation with different premiums. Okay, ranging from 500 until 2000. So simulating 50 sets allow me to get an accurate answer, accurate to 7 decimal points. Okay, so therefore it is already very sufficient for the result of the test. From this 50 simulation, I can identify each and every NPV of the premium within the range. So for example, okay, let's look at here. A premium of let's say a premium of 1000 will give me somewhere, will give me a net present value of, let's say, negative 850. Therefore, it is not wise for me to recommend 1000 premium for the policyholders. I will at least need to recommend 1464 premium, okay, in order to break even. Okay, so since our financial challenge is regarding uncertain interest rate, we have created a software, okay, where we could adjust the interest rate and fine-tune the premium based on the age, the gender, and the smoking status. Okay, of course, we have decided to charge a more expensive initial expenses and renewal expenses to smokers. Okay, as they give us more mortality charges and they are a bigger risk for us also. Okay, so as we can see here, smoker, they are being charged an additional 300 initial expenses, while for non-smokers, That's right. While for smokers, they are also being charged another 100 for their renewal expenses. Okay, so without further ado, let's move into a real life role play where you can see how this software is being utilized. Miss J, how can I help you with?
I would like to inquire about the 10-year unit-linked investment policy. I heard from my friend that it is a good deal as it combines insurance and investment.
Yes, it is indeed a good deal. Okay, the premium charge for 10-year insurance, endowment insurance, right, and the premium for unit-linked investment policies, right, they're actually quite similar. Okay, so despite being a little bit more expensive, but we give you the flexibility to choose the investment portfolio that suits your appetite.
What would happen if the Fed decides to increase the interest rate? Would that bring me a big loss? Should I invest later on?
That's a very knowledgeable question from you. Okay, so if the interest rate did increase, right, it is actually a good thing for you. Okay, a new policyholder. This is because the interest rate and the bond price has an inverse relationship. So approximately 70% of the investment portfolio of an insurance company, they will go to bond investment. Okay, so you can imagine, right? You are actually buying things at discount. Okay, so you can relax after that. Okay, we have professional actuaries to take care of your portfolio.
Oh, so how much would the policy cost me yearly?
Sure. Let me calculate for you using my software. Alright, in order to calculate the premium, I will need some information from you. Okay, I will need your age, I'll need your smoking status. Are you smoking or not? So let's start off with the age.
Okay, I'm 21 this year.
You're 21 this year. Okay, so female. Okay, are you smoking?
No, I'm not smoking.
No, that you're not smoking. Okay, so since just now, okay, you said you want to buy your insurance at 1st of March 2024, right? So using my forecasted interest rate, I have forecasted the interest rate will be around 5.7%. So let me adjust the interest rate for you. Okay, so here we have, okay, you will be charged a minimum of $924.55. Okay, so that will be your premium. So are you okay with that?
Yeah, that's very affordable. Count me in.
Okay, so thank you for your role play, Jane. So let me continue with the rest of the thing. Based on our simulation, we could observe that rising interest rate could be beneficial to the insurance company and the insurance policyholder when they are assigning policy to new policyholders. But it could seriously impact the investment returns of old policyholders. So this is due to bond and interest rate having an inverse relationship, and their fund value could be impacted negatively due to the rise of interest rate. So we could also prove several things here, okay, such that old people are being charged more expensive than young people. So let's look at here. Just now Jane was 21 years old, right? So she's being charged a premium of 924. So what if Jane is 50 today? Okay, she will be charged 1,152.90 cents. Okay, so you can see that, okay, older people, they are being charged more expensive premium than younger people. So another thing we can see is, okay, male and female. Okay, which one is being charged more? So let's say female is 1152. Let's change it to male. So we can observe that the premium changed to 1253, which makes sense, okay, because by nature, okay, male is a larger risk, okay, it's a more serious risk as compared to female to the insurance company. Okay, the most important part, which is the smoking status. So the non-smoker will get 1253. Let's say he smokes. Okay, so you can see here, okay, the premium increases largely, okay, approximately about $500. Okay, so that's the bad part of smoking. Okay, so this is for our presentation. I hope that what we have conveyed are beneficial to the industry. Okay, and yeah, thank you, Thomas.